Now, I think about digital capital. It's like you have a bunch of digital capital. You have $1 billion of Bitcoin on your balance sheet. You can carve out any digital credit instrument you want, right? And credit instruments are very, what's the degree of collateralization? Is it 10x over collateralized? What's the degree of liquidity? What's the credit guarantee? Can I get my money back in a year, in a decade, in a century? Is it perpetual? And what's the collateralization? Do you want 10 over collateralized or 5 or 2? What kind of credit risk is going to be embedded in this instrument? I can actually sell you that instrument and I can collateralize it 27-to-1. I can collateralize it 20-to-7-1 and give you a credit put, every 3 years, and I can completely change the nature of the credit.
Hey guys, welcome to Everyday Finance. The world of finance is about to fall apart. Investors have been stuck for years in things that look safe but steal their money. On paper, bonds, funds, and credit goods look stable, but in reality, they can't keep up with inflation. As a result, a system where following the rules leads to loss. It's a trap that looks like safety. Michael Saylor says there is a way out, though. He says Bitcoin isn't just another business. It's a way to stay alive. He thinks that Bitcoin treasury tactics are the beginning of a big change in the way money works. We're not just making small changes to the system. We're completely moving away from an old way of doing things and towards a digital future where capital finally helps the people who use it, but fear still rules. Huge institutions are stuck in the rules that gave them power and can't change direction. Even though trillions of dollars are stuck in large investments, investors want progress, but the risk of losing money stops them. Resistance to change costs a lot, and each day lost makes it harder to adapt. Now is the turning point. Either stay stuck with a system that is breaking down, or switch to digital before it's too late.
But once you embrace the idea that Bitcoin is digital capital, then the next issue is, well, what is Treasury company? Well, Treasury company is just a new kind of corporation, literally impossible in the world where public companies are capitalized on fiat credit. It doesn't make sense to sell equity to buy back sovereign debt because the equity cost of capital is above 14%. The sovereign debt has an after-tax yield of 3%, 2%, 1%. Doesn't make any sense. Doesn't make sense to issue corporate credit to buy back fiat or sovereign debt either, right? Makes no sense. What does make sense? Well, issue securities backed by digital capital. I'd like to say we understood this business 5 years ago. We didn't, right? Our entree into Bitcoin was first defensive, then it was opportunistic, then it was strategic, and finally it became transformational. Then we realized we're a different company. So what is the basic premise of a treasury company? Well, it's very simple. You have a block of digital capital, raw digital energy. Here, it's commodity. The world doesn't want it. What the world wants is a set of securities, either credit instruments or equity instruments or derivatives that meet their requirements. The analogy I've used before is Standard Oil. Think of a refinery. I have a block of raw liquid energy. Einstein said matter and energy, they're interchangeable. I have raw liquid energy in the form of a barrel of crude oil. The first application was kerosene. Kerosene is jet fuel. Kerosene lights up your house. Kerosene was light. Kerosene is rocket fuel. You can't light up your house with a barrel of crude oil. You can't fly a jet with a barrel of crude oil. So we needed kerosene. We refine it. We mark it up. But there's gasoline, there's diesel, there's asphalt. And then if you actually go on an AI and say, tell me all the specialty chemicals of crude oil, there's also lycra, there's also acrylic, there's also plexiglass, there's PVC piping, your lubricants, every form of plastic, stuff you eat, nylon, polyester, right? It goes on and on. We build the houses, we turn the machines, we look through these things, and they're all products, right? So I can refine it to be a different form of energy, whether it's kerosene or gasoline or diesel, or I can create lycra, or I can create plexiglass, right? And so products, services, forms of energy come from that barrel of crude oil. How big is that? Well, I mean, just think about, at some point, Standard Oil also owned half the gas stations. So you've got gas stations, you've got every type of energy, and then you've got DuPont, and you've got everything that every chemical company ever created. And look at the stuff you're wearing, probably. You're wearing stuff that came out of a barrel of crude oil, right? It's the stuff that's in your tennis shoes, right? So it's not a difficult stretch to say, oh yeah, in the first year when John D. Rockefeller, maybe 1865, when he started screwing around with a barrel of crude oil and out came some kerosene, a lot of haters said, well, there's no future to this industry, right? And of course, the industry today is, what, a third of everything. Now let's take that digital energy. What is the role of Bitcoin? You know, we say Bitcoin miners, they recycle stranded electricity or stranded energy. Well, Bitcoin treasury companies recycle stranded capital. Okay, more than half the capital, 2/3 of the capital is locked up in structured institutions right now. It's capital sitting in a bank, in a pension fund, an insurance fund, and a retirement account, and an institutional investment fund, and an index fund. In a money market fund, right? They're all locked up, the great majority of this capital, and they're in certain places. So what do they want? Well, you know, the insurance companies and the pension funds, they want long duration yield, right? That's what they want. The money markets, they want this very short duration liquidity credit spread. Everybody wants something different. The equity investors want leverage on some underlying business model. The derivative investors want that. Now, if you think about, think about the process of creating a piece of digital credit. What I think in my mind is, this is a block of plexiglass, or this is a block of acrylic. Just think like a big block of plastic that's a meter by a meter by a meter. And then I have a CAD/CAM system and a computer-generated machining, or a machine that's computer controlled, so I can operate the lathe and I can chip out anything I want from that block of plastic. So I put in whatever my image is, I unleash the computerized machine, and I get out some beautiful sculpture, right? Not quite 3D printing, but something like that. I'm converting a block of raw material into something, a beautiful work of art. And of course, what does the person want to see? How many different types of sculptures? There's infinite types of sculptures, and they're all just coming from a single block of some kind of acrylic or plastic. Now, I think about digital capital. It's like you have a bunch of digital capital. You have $1 billion of Bitcoin on your balance sheet. You can carve out any digital credit instrument you want, right? And credit instruments are varied. What's the degree of collateralization? Is it 10x over collateralized? What's the degree of liquidity? What's the credit guarantee? Can I get my money back in a year, in a decade, in a century? Is it perpetual?
Michael Saylor thinks that the first year of a real financial change has just begun. From his point of view, people are going from physical capital like gold to digital capital, with Bitcoin at the center. He says Bitcoin is pure economic energy, which means it is a form of capital that doesn't lose value over time and can stand firm in a world that isn't always stable. He makes a strong comparison to explain. When it was raw, crude oil was messy and didn't work well. Fuel for the industrial age, though, was oil and petrol that were made from it. He says that Bitcoin is the same way because it is the raw digital material. Bitcoin treasury companies will make it better, turning it into useful financial goods for everyone. There are a lot of different ways that these instruments can be used, from perpetual bonds for pension funds to low volatility instruments for retirees, to hedged securities for company treasurers. The rise of AI speeds up this change. Legacy finance is still stuck in rules and old ways of doing things. but AI can quickly create and improve new financial instruments. Saylor says that when digital wealth and digital intelligence come together, they make a force that can't be stopped. We are not seeing a change. We are seeing the start of a new age.
What kind of yield does it give me? What's the yield curve? Is it high duration yield? Here's the magic trick, right? You're a Japanese company. You want to create 5% yen, 5% yield in yen forever. How do I create that, right? Is there a market for that? Yes, there's like trillions of dollars of money markets in yen that get 50 basis points. So if I can carve out 500 basis points and I create this currency, I'm going to take the currency risk of the yen. I'm going to create this yield. I'm going to actually create duration forever. And what's the collateralization? Do you want 10 over collateralized or 5 or 2? What kind of credit risk is going to be embedded in this instrument? I can actually sell you that instrument and I can collateralize it 27-to-1. I can collateralize it 20-to-7-1 and give you a credit put, every 3 years, and I can completely change the nature of the credit. Or I can collateralize it 2-for-1. I can create sub-junk yield, right? And I can give you a different instrument. So when it comes to credit, you've got all sorts of investors. The Russians don't want US credit. The Chinese don't want US credit. The Japanese don't want US credit. The Canadians, the Europeans, they don't want to take credit. They don't take currency risk. So you can create a credit instrument, if you're a Bitcoin treasury company, in any currency, with any degree of duration, with any degree of collateralization, with any degree of volatility. I talked to a guy probably richer than everybody in this room, and he's got a bit of Bitcoin, and someone says, well, why do you only have like 1-2% of your portfolio in Bitcoin? He says, well, frankly, I'm like something years old, and I can't handle the vol. Okay? 75-year-old, 80-year-old guy with a lot of money, he just doesn't want a 50 vol, 50 ARR instrument that you have to hold for, if you call it indefinite duration, in theory it's 120 months. So if you're willing to hold this thing for 10 years, somewhere between 120 and 240 months, I'm pretty confident you get yourself like 30% a year ARR. But when you're 92 years old, who wants to actually hold something for the next 25 years? They don't want it. And so there are a lot of people, there are very wealthy pockets, and they can't stand the duration. They can't handle the volatility. Another example of people can't take the vol, corporate treasurer. You've got a Bitcoin company, you believe in Bitcoin, but you got to make payroll and you need to make your rent. And so you have working capital. Conventional wisdom is keep 1 year of working capital into the currency that your liabilities are denominated in. That's your treasury. You're not going to put that in Bitcoin. You're going to put that in, right now you're going to put it in a money market, and in the US it'll give you about 3% after tax. But in Japan, it's going to give you 25 basis points after tax. In Switzerland, it's going to give you minus 50 basis points. The entire yield curve in Switzerland is negative out to 4 years. In Europe, it's going to be 200 basis points, maybe. So you've got how much? 30, 40, 50 trillion dollars tied up in treasury instruments and money markets and the like between Japan, Europe, Switzerland, Canada, the US. 30 trillion in the US alone. They can't stand the vol. They want you to strip the vol. They want you to strip the interest or the yield duration off the instrument. Just give them pure spread. So what is the closest thing to kerosene that we can produce in this industry? It's basically pure yield. Something like we created with Stretch, it's like if you can just strip away the current, I live in Japan and I like the 400 basis point treasury, but I can't stand the US dollar risk. I can't stand the currency risk. Strip away the currency risk, strip away the duration risk, strip away the volatility, strip away the credit risk, give me liquidity, right? Serve it up to me in some sort of credit instrument. And, you know, take Metaplanet, they're sitting on billions of dollars of Bitcoin. If they can open up the credit side of that trade and they can sell Meta yield at 5 or 6% in JPY, they'll be arbitraging 50% US dollar ARR versus 5% in the yen, and they capture the 45% spread, right? Which is, to say they're getting 90% of the economic gain is an understatement. They're getting 100% of the economic gain up front. They're getting 90% in the first increment, compounding exponentially. So when you set up that instrument, you're getting like 95% of the economics.
Saylor draws a picture of the future that is almost too big to understand. He thinks that thousands of Bitcoin treasury companies will pop up around the world, each one designed for a different market. These could be established financial hubs like Switzerland and Japan, or new countries like Brazil and Nigeria. Their job is to wake up capital that is lying dormant and turn it into something alive, useful, and satisfying. However, this isn't just about making money. Fixing a broken system is what it's about. These businesses will keep the Bitcoin network safe while putting good money at the center of global finance, businesses, banks, and people's homes. As they grow, they'll put pressure on lawmakers to update their rules and on financial infrastructure to change. This will slowly change the way people think about money. But there are risks on the way forward. Fluctuations will shock people who aren't ready. Companies that are impatient and look for quick fixes will fail. Pioneers will be those who have the vision, discipline, and toughness to build long-lasting systems that meet real needs. Whether those needs are for individual investors, company treasuries, or global institutions. Saylor says this is a once-in-a-lifetime chance for buyers. Bitcoin bank companies are not the same as other types of assets. They are the beginning of a new era. They will bring Bitcoin's growth in a more polished form that works for every market, every currency, and every level of risk. In the same way that Standard Oil made crude oil into the building blocks of modern industry, these companies will make Bitcoin into the core of a new financial system. Now, the question is not if this change will happen, but who will lead it. The change has already begun. You have a clear choice. Stick with the old system that drains wealth, or accept the future that is being built by those brave enough to take the lead.